So good afternoon, class. Dear students, I hope all of you are safe and doing well after final exam week. First of all, let me congratulate you with accomplishing one of the challenging semesters during your academic life, and also one of the challenging, not only challenging, but also important, insightful course, Principles of Finance. Today, the aim of my recording this video is to solve these questions, a final exam open-ended questions for you, those can be interested in the solutions of these questions. I will use Excel to solve and explain step by step and detail of the questions. Without losing a time, I would like to start with the first question. So it's here. IBA, International Bank of Azerbaijan shares are traded at 100 AZN. Option premium should be your ID number. So if your ID number is 4-digit, just divide them by 1000. It's also applicable to 5-digit ID numbers. For example, if your ID, as indicated here, 9876, divide them by 1000. It should be, for example, 876 AZN as option premium. Also, in 5 digits, it's also applicable. The question is asking, plot the terminal payoff in A part. Payoff from a European put option on one share of IBA with an exercise price of 120 AZN and the maturity of 3 months for investor who wants to buy this option. This is typically the graph of buying put option. I will use my ID number for all these questions. Student ID, it is my ID, 4077. And it is question 1, A part. Oops, A part. Okay. I have spot price, which is 100. It's 100 and 120 exercise price. Let me choose AZN from the currency list. Okay. Strike price, 120. It's also AZN, and option price, which is your ID number. I'm adjusting the format here, and ID number divided by 1000. Increase the digits, then ID is my option price. So our option is buying put option, European put, and the investor who wants to buy this option. So buying put option graph. Let me draw this graph for you. I can start from here. Okay, that's enough. It is y-axis of this graph, which is our profit, which shows our profit in the option. And this is the stock price, share price graph. Oops. It's very long. Let me shorten it. Enough. That's enough. So this line represents the stock prices and this line represents our profit. Our spot price is 100 and strike price is 120. So there might be other prices, 80, 60, 40, and also 140, 160, and etc. So we know that if option price, if the stock price is more than the strike price, if spot price is more than the strike price, I am not going exercise to put option because market offer me higher price than the option, put option. So therefore, I will not exercise my option and I will go to the market and sell my shares at higher price. So therefore, till 120, I am in loss. Which loss? Option price loss, because I bought the option, but I didn't exercise it. So therefore, my only loss is the option price. Let me draw the line. Line starts from here. For example, here. Till 120. Okay. Also, let me again draw another line. So this is profit. It shows profit. Let me write here, profit. And this is share prices. Okay. And I am in loss of option price. So starting from here, I don't know what is the price. Till 120, I am in loss of only option price because I am not exercising it. But if share price starts to decrease from 120, my profit, in other words, my loss is getting decreased. Till where? Let's calculate it. So till where? 120 minus option price. Okay. What does it mean? If I sell my share at strike price and the spot price of this stock is 115 point something else, I have a profit. I have a profit of 120 minus this price. But it is also the price of the option, so I have to pay premium. Therefore, my profit is zero ASEAN. So I am not making any profit right now, but my loss is getting decreased. Let me Draw another line. From here, it should cross 0 at 115 stock price. That's it. It is our graph. So I want to decrease the size of this graph a little bit. Okay. So our graph is ready. Buy put graph. In this field, let me take all this cell and merge. We are still in loss. If share price is more than 115.923 ASEAN. Okay. In this part, we are in loss because we are not making any profit, but starting from 120, our loss is getting decreased. But in this part, we are making profit. We are in profit if share price, in this case, is less than 115.923 ASEAN. Let me change the color to in green. So part A of the question is done. Let's switch to what the part B is asking for. So suppose that you purchase the option, put option at, again, it should be your ID number from the market. Specify the ranges of IBA share price at the option's maturity date for which you will be making a profit. We actually already did it on the graph, so we can again wrap up it. Question 2B part. This is, yeah. Okay. B part says in B part, so according to the graph, if share price is more than 160, as you see, if share price is more than 160, our loss is equal to option premium. If share price is more than 140, again, our share loss is option premium. If share price is more than 120, again, it is the same because a line is flat here till 120. option premium loss in amount of option premium. But if share price greater than 115.923, but less than 120, okay, I will be making again loss, but it is less than option premium, because starting from 120 till 115, my loss is getting decreased, and at 115, it becomes 0. So if share price is less than 115.923, our profit, we will be making profit, is greater than 0. So making profit range, profit if P is in between 0, P is stock price, is in between 0 and 115. So we are done with the both parts of the first question. That's how first question is calculated. Question 2 says, after the coronavirus pandemic problem, you are planning to visit some friends in Paris, London, and Ankara. You plan to spend equivalent of 2,000 ASEAN each in Paris, Ankara, and London for a total of 6,000 ASEAN. 2,000, 2,000, 2,000 is equal to 6,000. ABC Bank in Azerbaijan offers you the following bid-ask quotes. So our base currency is in the left side, quote currency is in the right side. It means 1 USD is equal to ASEAN, 1 euro is equal to USD, 1 USD is equal to Turkish lira, and 1 British pound is equal to USD. Again, we will be using our ID number, but for 1 British pound quotation. So our ID number is our bid price, a bid rate, but if we add 0.0010 to this bid quotation, we will get offer. First of all, let me try if I can copy this table. So question 2, A part. Can I copy it? Yes, luckily. If your ID number is 00009876, use 0.98. So it means we are dividing our ID number by 10,000. For example, ID number divided by 10,000. And I am adding to bid price, bid rate 0.0010. It should be, yes, 0.0010. Okay, offer price is more than the bid price. It is always the case. So I am spending 2,000, 2,000, 2,000 ASEAN in 3 cities. City, Paris, which is nominated in Euro, London, which is nominated in GBP, and Ankara, Turkish Lira. I have ASEAN. I'm gonna spend 2,000 ASEAN each. And then let's look at what the question is asking. Banks do not offer Euro, Turkish Lira, GBP against ASEAN. First, you need to convert your ASEAN to USD. Be careful about bid offer quotation. You will not get full credit. So we are not interested in this part. The hint says we don't have any currencies quotations for Euro, GBP, and Turkish Lira against ASEAN. Therefore, the question is suggesting that, firstly, we should convert our ASEANs to USD, and then using these quotations, we can convert the currency we are looking for. First of all, to USD, let me write like that, to USD. In order to convert it to USD, I have to know what is the rate of 1 USD. 1 USD is equal to what? How much is it? We see that bid price is 169 and offer price 170. So offer price means it is the price that USD is offered. So if I want to convert my ASEAN to USD, it means I am selling my ASEAN and getting USD at offer rate. Therefore, I should divide my ASEAN amount by USD ASEAN offer. Offer. Okay. And we should use 4 digits after the comma. Drag down. Yes, they are the same. We converted our ASEANs to USD, and then is using these rates. Okay, they are in the place. We can convert to Euro, GBP, and Turkish Lira. Let's look at which rates we should be using. We have USD, and we should convert it to Euro. It means we are buying Euro and selling USD. Therefore, we should be interested in one price, a price of 1 euro. How much euro is offered? Euro USD offer rate is 120.2222. Again, I am explaining. I have USD and I want to convert them to euro, which means I am selling my USD and getting euro. But at which rate I can get by euro? At offer rate, because bank offer you euro at this rate. It is 1 euro price. 1 euro is equal to 102.22 USD. So therefore, I am dividing equal USD amount by offer rate. Why it is in the middle? Okay. So my 2000 ASEAN is equal to 173 USD and 959 euro. We will use the same way to calculate GBP. So I have this amount of USD and I want to buy convert it to British pound, which means I am selling my USD and getting British pound. But at which rate I can get British pound? offer rate, British pound offer rate, because its base currency is GBP. 1 GBP is equal to 0.477 and 0.87 USDs. So I am buying British pound, therefore I should use GBP offer rate. Okay. So 2,870 euro British pound is equal to 1,173 USDs. Ankara Turkish lira, the last. I am converting my USD to Turkish lira. So therefore, it means I am selling my USD and buying Turkish lira. I should be interested in 1 Turkish lira price, but here I don't see any lira quotation in the base currency list. Instead, we have USD to Turkish lira, which means USD price, 1 USD price against Turkish lira. So it means instead of selling Turkish lira at offer rate, I can buying Turkish lira at offer rate, I can sell my USD at bid rate, this bid rate. Again, I am explaining. In euro and in British pound, they were base currencies. So I want to buy them. Therefore, I divided or multiplied. I'm sorry. I divided by their offer rates. But here, I cannot divide by offer rate because my base currency is USD and quote currency is Turkish lira. Therefore, in this case, instead of using the logic buying Turkish lira, I can use the logic selling dollar. They are the same, but in the quotations, we should use bid price of the USD because at bid price, I can sell my USD. Bank will give me 9,795 and etc. Turkish lira to give to me. We're done with the first part, A part of the question. Second part says, if you return with 300 euro, 1,000 Turkish lira and 75 British pound, if exchange rates are unchanged, how much ASEAN do you have? It is again the same logic. So city, let me write here, question 2B. Okay. City, Euro, GBP, and Turkish lira. In this case, we are converting from Euro, GBP, and Turkish lira to ASEAN in order to know how much ASEAN we have left in each cities. We have 300 euros. 300 euros, 75 British pound, and 1,000 lira, Turkish lira. Okay. This again method in the above, I should convert them first to USD and then to ASEAN. To USD to ASM. So I am converting my euro to USD. Mən avromu satıram və USD alıram. I am selling my euro and buying USD. So if I am buying USD, I should be interested in 1 USD price. Bayaq dediyim kimi, əgər biz hansı currency-ni almaq istəyiriksə, həmin currency-nin base olaraq düşünməliyik. Yəni, məsələn, dollar almaq istəyirik, dolların currency-ni düşünməliyik. 1 dollar neçə AZN-dir? Və təbii ki, offer rate-nə baxırıq, çünki biz offer rate ala bilərik. We should be looking at the offer rate of this currency. For example, you went to the market, not the market, smartphone market, the market where smartphones are sold. You want to buy iPhone. So if you want to buy iPhone, you should be interested in the price of one iPhone. It is also the same logic here. If I want to buy USD or ASEAN or Euro, I should be attached to the one price of this one currency. So I should be looking for USD to USD to Euro as a base currency, USD, and quote currency Euro. But I don't see any base currency USD and quote currency Euro here. Instead, I have Euro to USD. So the previous logic can also be applied here. If I want to buy USD, it means I am selling my Euro. If I am buying my USD at offer rate, I can sell my Euro at bid rate. Therefore, if I have 300 euro, I am selling it, and 1 euro price is 1022. 18 USD, 1.22 18 ASEAN, 18 USD. Again, I am saying it. Okay. I'm dividing, multiplying amount with this rate. Again, I'm explaining. I have euro here, 300 euro, and I want to buy USD. I am selling my euro and buying USD. I don't have base currency of USD to euro. Instead, I have euro to USD. So it means I can use the logic of I am selling my USD at which rate? Bid rate, because bank will buy euro at bid rate from me and sell to me at offer rate. Therefore, I used bid rate of euro because I am selling my euro at bid rate to USD, and I have got 366 and etc. USD. Then I am converting to ASEAN. If I am buying ASEAN and selling my USD, I should be looking for one ASEAN price because I am buying ASEAN. But I don't have any ASEAN to USD quotation. Instead, I have USD to ASEAN quotation. So instead of using buying ASEAN, you can use selling USD. Selling USD at bid rate. Therefore, multiply your USD at bid rate. The same logic is also applied here. So before starting calculation, let's clarify what we should do. We have 75 British pound, and we want to sell our British pound and get USD. Therefore, we are buying USD. We should be interested in one USD price, but we don't have any base currency as USD to against to British pound. Instead, we have British pound to USD. So instead of using the logic of buying USD, we can also say selling British pound at bid rate. British pound at bid rate. And to ASEAN, the same as we did before. We are taking USD ASEAN bid price because we are selling USD. So Turkish lira to USD, we have USD price, USD to Turkish lira. If I buy USD, if I'm buying USD, I should be focused in one USD price. But luckily I have one USD price. Diğerlerinde USD price verilmemişti. Biz çevirip daha doğrusu diğer o bir logic istedi. Ama burada biz one USD price, we have one USD price against Turkish lira, and we want to sell our USD. At which rate we want to buy USD? At which rate we can buy? Offer rate. So I'm sorry, it should be divided by. Okay, because dollar is more valuable. Again, I'm repeating. I am selling my Turkish lira and buying one USD, buying USD, and USD price, one USD price is given this and this, and I should use offer price because I can buy USD at this rate, offer rate. So therefore, I divided Turkish lira amount by USD, by USD offer rate. And then the same way of calculation with price of USD ASEAN, 202 point, and etc. So that's how question 2 is solved. Question 3 says you are planning to invest in 2 stocks and risk-free asset. You are sure that the economy is expected to behave according to the following table. You see the table there. Likelihood of each scenario is given next to the state of the economy. You are planning to invest where you put a quarter of your money in stock A, half of your money in stock B, and quarter of money in risk-free asset. You also know the following information. So we have this table, and we should use our ID number as a risk-free rate. Let me try to copy this table to our Excel file. So question 3. Oops, what happened there? Okay, I somehow adjusted. This one goes to here. I am deleting it. I am unmerging it. Unmerge. I am deleting that part. Okay. What's written here? Okay. What happened to everything is in the place? Okay. So as a risk-free rate, I can use my ID number as indicated in the question. So my ID number this one divided by how much? 100,000. 100,000 because when I convert them to the percentage, they will be the same digit. They will have the same number of digits as my ID number. Okay, that's fine. So what the question is asking for? Calculate total risks for stock A, stock B, and the risk-free asset. Then calculate expected return for your portfolio. Let me copy this from here to here. Let's call this cell as return of each state return, and I'm deleting them. So the question says I am putting half quarter of my money on stock A, half of money stock B, and quarter in risk-free asset. So if I am putting quarter of my money in stock A, it means I will take quarter of stock A return, half of stock B return, and quarter of risk-free rate. So equal 0.25 times return of stock A plus 0.5 times return of stock B plus 0.25 times return of risk-free asset. $577, $677, and $177. Also, I can calculate the total return for each asset. So total return, I don't have any probability here. Total return is equal to probability times recession return plus normal probability times normal return plus probability times boom return. So I am fixing the cells. $0.780 and 4.088. It should be also, yes, it is risk-free return. Risk-free asset has the same return in all cases. Therefore, total return stays the same as 4.077. Right. So we can find portfolio expected return. Portfolio expected return is equal to probability times a return of each state and this. What happened here? Oops, it should be okay. the sign was incorrectly written as plus sign. Multiply, multiply, multiply. Okay, it is true now. 4.77. It is our expected return. Expected return of your portfolio. We done with, we calculated B part. Standard deviation. Standard deviation for each asset. For B and standard deviation for risk-free asset. RFs. You know that standard deviation formula is equal to times probability is equal to probability times multiplied, you open the bracket, recession return minus expected return of the stock to the power of 2 plus normal probability multiplied by normal return of this stock minus expected return of this stock to the power of 2 and plus boom probability times boom return minus total return, expected return of this stock to the power of 2. But it will give us the variance, so therefore I should take square root of variance in order to get standard deviation. And it is 12.22. Okay. The standard deviation for stock B. Standard deviation for stock B. Again, times probability times return of stock A, recession return of stock A minus expected return of stock B. It should be stock B, I'm sorry. Plus normal probability times normal return of stock B minus expected return of stock B to the power of 2 and plus probability times boom return of stock B minus total return, expected return of stock B to the power of 2, and it is variance since, therefore I am taking square root of it by a squared using a squared formula, and it is 9.79% standard deviation. And the standard deviation risk-free asset, you know, it is 0 because it is risk-free, so therefore it doesn't have any standard deviation, so it doesn't have any risk. Standard deviation of risk-free asset is 0. Or you can also calculate it just to make sure, but you see that the return, each return is equal to expected return, so I am subtracting same amount from the same amount. It will give 0 in each probability, so 0 plus 0 plus 0 is 0. Risk-free rate, standard deviation. So we are done with A part. And what is the total risk or standard deviation of this portfolio? Standard deviation of the portfolio is equal to STDEV for portfolio. Okay. Equal probability times recession return of the portfolio minus expected return here of the portfolio plus normal probability of the portfolio multiplied by normal return of portfolio minus expected return of portfolio power of 2 and to the power of 2. Since it is done variance, I should take square root of it. I calculated total risk of the portfolio. And the last part, calculate the risk-return trade of each stock alternative and portfolio. Which one of the best investment idea and why? Risk-return trade of portfolio or stock, you see, you know that it is the calculation of coefficient of variation. Coefficient of variation is calculated by dividing standard deviation of any asset or portfolio to the return of any asset or portfolio. So coefficient of variation represents that how much risk is per 1 unit of return. How much risk, how many units of risk is per 1 unit of return. Therefore, we should calculate coefficient of variation. And coefficient of variation, risk-return trade of each stock alternative and portfolio. So stock A and stock B and portfolio. So we don't consider risk-free asset here because risk-free asset is risk-free. It doesn't have any coefficient variation. Its coefficient variation is equal to 0. We don't consider it in the question, only stocks and portfolio. So coefficient of variation of A, coefficient of variation of B, and coefficient of variation of portfolio. By formula, coefficient of variation of A is equal to standard deviation of A divided by expected return of A. Coefficient of variation of B is equal to standard deviation of B divided by return of the B. And portfolio, standard deviation of portfolio divided by expected return on portfolio. Coefficient of variation of A is 0.91. So which means for each unit of return, you are facing with 0.91 units of risk. For stock B, for the 1 unit of return, you are facing 12 times more than 12 times more risk, which is very dangerous, very bad. And portfolio, it is the less riskiest because it has less coefficient of variation. For 1 unit of return in the portfolio, you are facing this 0.47. So as a result, and question is asking which one is best investment idea and why. Portfolio is best investment idea since lower coefficient of variation. It has lower coefficient of variation, therefore it is best. Then stock A comes. Stock A might also be investment idea, but after portfolio, because its coefficient of variation also less than 1, but more than portfolio. However, the worst case is stock B. Stock B is the worst investment idea since higher coefficient of variation, because for 1 unit of return in stock B, you are facing with 12 units of risk standard deviation. That's how question 3 is calculated and solved. Now we are in the fourth question, the last question of your final, and it is bonus question. It is the spot and future price of gold given below. Spot price as of now, and 3 months forward, 6 months forward, 9 months forward prices. And we should find the rate of which these prices are increased, the rate, changing rate. And then we have to calculate annualized interest rate. So let me firstly copy this table to here, question 4, bonus. Oops, bonus. Okay. In order to convert our periodic interest rates to annual, we should use day count conventions. How many days in our 1 year and 1 month. I am using day count convention traditional, which is 30 divided 360. 30 360 day count convention method. You can find interest rates, calculate them 3 months, 6 months, and 9 months. 3 months interest rate is equal to 3 months gold price, open the bracket, 3 months gold price minus spot price divided by spot price. Let me convert to percentage. 6 months, it is also the same case for 6 months. 6 months price minus spot price. I'm finding the rate, change rate, interest rate, in other words, divided by spot price. And 9 months price minus current price divided by current price. So they are periodic interest rates, but we looking for annualized interest rate. We know that we have 4 quarters in 1 year, and 1 quarter consists of 3 months. So therefore, this rate is quarter rate, and it should consist of 1/4 of annual interest rate. Yani 3 aylık bu quarter'de 0,11 faiz. Biz bunu annual'a çevirmək üçün bilməliyik ki, hansısa annual rate'in 4də 1-i 0,11 eləyib. Bunun üçün for that equal interest rate multiplied by 360 divided by 90. Because of our day count convention, I use 360. But why 90? Because I have 3 months, and each month has 30 days in 1 month. 30, 30, 30, it is 90. For 6 months. We know that 6 months is half of a year, so therefore its interest rate should be half of the annual interest rate. Multiplied by 360 divided by 180. And 9 months. 9 months is 3/4 of annual year. I'm sorry. Let me charge it. Okay. So 9 months is 3 quarters. We have 4 quarters in a year. So therefore, 9 months rate, interest rate is 3/4 part of annual. Yani it means multiplied by 360 divided by 270, because we have 9 months and each 30 days. 30 multiplied by 9, it is 270 days. And this is our annual. So we are done with final exam open-ended part. I will send the recording link. I will upload it to YouTube and send the link to you, and also this Excel file to you. I hope you understand these questions, the solutions. If you have any questions, any concerns, if you have anything, any part left unclear, just write me. I will explain you in detail. Thank you for your attention.